So, value of the firm. The value of the firm is driven by three considerations. We have market factors, firm factors, and investor factors. So, market factors are in economic conditions, government regulations and rules, competitive environment, domestic and foreign. So, the conditions in both the home country and foreign countries affect the value of a firm. Regulations, as I mentioned in previous lecture, the Sarbanes-Oxley and Dodd-Frank are considered to be very cumbersome by U.S. corporations. The uh, the cost of following those regulations is literally in the hundreds of millions of dollars, uh, and it's and is considered to be a disadvantage for U.S. corporations. It has been used as an excuse for many foreign firms for choosing not to participate in the U.S. financial markets. Uh, Firm factors, operations, revenues and expenses, financing, investment, dividend policy. Then the other side, we have investor factors, income, savings, age, lifestyle, interest rates, uh, risk preferences. So these, the firm, the, the firm factors drive net cash flows, and the investor factors drive the investor's required rate of return. So we take that required rate of return and we present value those cash flows, and those are how we determine the value of the firm. So the value of the firm equals the current present value of expected future cash flows. That is all expected future cash flows based on return demanded by investors that are, which is dependent on the risk associated with that firm. What investors, how comfortable are they with that firm? How do they feel? So, so factors influenced by managers that affect stock price. So cash flows or projected cash flows, the timing of those cash flows, the risk of those cash flows, the earnings, like how certain are those earnings, how volatile are those earnings. That's a big factor with regard to how firms are valued. Firms with more secure cash flows are going to be worth more than a one with less secure or more risky cash flows. Use of debt as far as capital structure, dividend policy. The dividend policy. The question there is, are we going to pay out the money to our shareholders? Or are we going to reinvest it in the company? It's a huge decision. As I mentioned before, if the company doesn't have profitable projects, that means projects that it meet or exceed the company's cost of capital. The company would actually be worth more if it paid that money out, as opposed to reinvesting it in the company. Kind of hard to imagine that, but it's very true. Agency relationships. I mentioned this earlier. Principal agent problem. So an agency relationship exists whenever a principal or an owner, this is also a shareholder, apologize for the poor writing, so hires an agent, when you are a shareholder, you're hiring the management of that company to work on your behalf. The agency problem results when the management makes decisions that are not in the best interests of the principals or shareholders in this case. So shareholders versus managers. Managers, they're naturally inclined to act in their best interest. So how do we handle that? So we create mechanisms that'll motivate managers to act in shareholders' best interest. This is why you hear about the or one of the reasons anyway that you hear about, for example, corporate CEOs making so much money with on their stock and the stock options and so forth, because they use these to incentivize management to align their interest. So, managerial compensation, align their compensation with the profits of the firm. Shareholder intervention, that can be a takeover, that can be removing the board, so forth. Threat of a takeover. So, all right. We'll start the next lecture with business ethics.